Hello, good afternoon. I'd like to welcome everyone very much onto this Oldfield online event. I'd like to thank everyone very much for joining us this afternoon. And we're going to have a value-packed hour-and-a-half session where we're going to talk about strategies for you to take away to help reduce the cost of providing company cars to employees and directors, and to really focus on strategies to reduce the tax paid by employees so they can keep more of what they earn. So we've got three others on the panel this afternoon, and we've got Joe Brewer. Hello, Joe.
Hello, Carl, and a very warm welcome to everyone joining us on this webinar.
We've got Jack Bennett. Hello, Jack.
Afternoon, Carl. Good to be on. Thanks.
And we've also got Jerry Surtees. Hello, Jerry.
Thanks, Carl. Afternoon all.
So just before we go straight into the content, I just wanted to quickly run through a couple of housekeeping points. First one was just a practical point on viewing this webinar. We find it's actually best and you get the most value out of the session if you actually look at this webinar in side-by-side mode. So if you go to the top of your screen, you should be able to see a view options button, like I'm showing you on screen. You should be able to just click that drop down and click side-by-side mode, and that will let you see the slides and us side by side, so you can get the best out of this. We are going to have a question and answer session at the end of the event. So if you've got any questions as we go through, please do feel free to put those in the Q&A box, and we'll be collecting those up at the end and doing our best to answer as many of those as we possibly can. If you've got any technical problems or queries, feel free to put those in the chat box. But any questions, make sure you put those in the Q&A box. There will be a copy of the slides available after the event. Just look out for an email that will be coming shortly after the event. You'll be able to get a hold of a copy of the slides then. So let's keep moving. The question of, why are we here this afternoon? Well, the fact is that company cars and company car benefit is a very complex area. It's an area where things are changing the whole time. And the way that you ran company cars a year ago or 3 years ago won't necessarily be the best way to run them now, because tax rates and tax thresholds are changing the whole time. It's not easy to keep on top of them. Well, that's really what we're here for. So the result of the fact that things are changing the whole time is that you can end up with some absurd situations. We can end up with situations where employers are paying significant amounts of money for a provision of company cars to employees or directors. And we can also end up in a situation where the employee is also paying huge amounts of personal tax on that benefit as well. And we have situations coming up the whole time. Just an example, the other day we had a situation come up with an employee that was, he was earning pretty well, but he was also struggling to make ends meet. And we just happened to look at his car situation because his employer was starting to talk about replacing his company car. And when we looked into it, he was basically paying around £500 or £600 a month in company car and fuel benefit tax. And we just thought there's got to be a better way of doing this. There's got to be a better way of looking at this, to save the employee all of that tax and to also save the employer some money as well. So that's really what we're here for today, is to talk about those key strategies from a tax perspective. And I'll just run through the agenda, just coming up on slides now. So firstly, we're going to talk about how company car tax works. We're going to run through the basics of how it works. Then we're going to talk about the critical question of whether you run vehicles as company cars or whether you run them privately, both for employees or for directors. We're then going to talk about some interesting non-conventional vehicles and the tax strategies you can look at around those. We're then going to look at some interesting options and comparisons. And then we're going to have a question and answer forum. And then we're going to wrap up with a summary and with some key takeaways for you to really take away with you. So I'm going to kick off with the first section here on how company car tax works. A lot of you will probably know about this already, but I think we thought it was really important that we just cover off the basics right at the start, make sure everyone really understands how company car benefit works, so that we can all then get the best value out of the rest of the session. So there's three key areas that I'm going to cover off. I'm going to cover off how company car tax works, how fuel benefit tax works for normal cars. Then I'm also going to talk about van and fuel benefit tax as well. So to kick off with company car tax, how does it work? What are the principles? So company car tax occurs where a business provides a car to an employee or to a director that is available to be used for private use by that employee or by that director. So if there's a car provided for an employee or director and they can use it for private use, it's available for use for private use, then company car benefit is incurred. And ultimately the way it's calculated is by taking the list price of the car, you multiply it by a percentage which is set by HMRC, and it's based on the emissions of the car. And that gives you your benefit in kind. And the benefit in kind figure, I've got an example there of £10,000. The benefit in kind figure is then added to your income and it's taxed effectively as employment income on the employee or the director. So you can see the basic principle, is that the higher the list price of the car and the higher the CO2 emissions, the higher the benefit in kind is going to be, and therefore the higher the tax the employee or director is going to pay on that car. So I've just got two key examples here, two kind of familiar cars that everybody would have seen before, just to illustrate the point. You've got a Land Rover Discovery there at the top, got quite a high list price, £69,000, quite high emissions as well. So it's got a percentage there of 37%. Take the 69,000 times it by 37%, that gives us the benefit in kind. And that's pretty high actually for a Discovery, nearly £26,000. Then on the bottom there, you've got a Citroen C1, other end of the spectrum, £15,000 list price, times it by the emissions, which are actually quite a bit lower, and you get your benefit in kind on a Citroen C1. So I'm not sort of recommending everyone goes out and buys Citroen C1s. I'm just purely illustrating the point about list price and CO2 emissions and the effect that has on company car benefit. So that's company car benefit in a nutshell. That's how it works. Company car fuel benefit. So this happens where a employer pays for fuel for private journeys for an employee or a director. And HMRC sets a value for the provision of private fuel each year. And in the current year, that's £24,500. And then the same percentage that we used before, that's based on the CO2 emissions of the car, that percentage is used, and that gives us our benefit in kind for fuel. And just in the same way as before, that benefit in kind gets added to your income and it gets taxed effectively as employment income. And I've got the same examples on the slide there for the Discovery and for the Citroen C1, so you can see that in real life. You've got your £24,500 times by the CO2 emissions, that gives you your benefit in kind. So that's hopefully just explains how company car tax and how company car fuel benefit tax works in brief. I'm now going to just touch on van benefit and van fuel benefit. This is quite different to the way it works for normal cars. This occurs when an employer provides a van or a commercial vehicle that's available to an employee or a director for private use. Basically, HMRC publish a fixed benefit in kind amount for vans and for van fuel benefit every year, and they update that each year. It doesn't actually matter what the emissions are of the van. It doesn't matter how big it is, how small it is, what shape it is, Doesn't matter how luxurious it is or not. The benefit in kind is just a fixed amount that's updated by HMRC on an annual basis. So you can see I've got the figures there for the current tax year for van benefit and van fuel benefit. Quite simple. You can see very clearly from this that vans or commercial vehicles do enjoy much lower levels of benefit in kind than normal cars do. So that's just something to take away straight away and to think about. Now, it is all likely to get a lot worse over the next few years. That's the bad news. That company car tax is only likely to get worse. Everyone will be familiar with the VW emissions testing scandals that erupted going back some years now. Well, the fact was that actually accelerated some significant changes that have come into force from April this year. And that's changed the way that vehicle emissions are tested and measured. And what that means is that official emissions figures are now more realistic and means that they're therefore quite a lot higher than they were previously. And obviously you'll understand that has quite a knock-on effect on the benefit in kind figures and therefore the actual tax that employees or directors would have to pay on a company car. So company car tax is going to get more expensive. It is going to get worse. It is going to get more onerous. And so it's all the more important that we get this right, that we get company cars right. So that's really why we're here. So I'm now going to hand over to Jerry Surtees, who's going to talk about the key question of whether you run cars privately or on the company. Thanks, Jerry.
Thanks, Carl. So this is an important question, and it's one that we get asked about on a very regular basis. And it's relevant to both employees and directors. So I'll be addressing the question from kind of both perspectives, starting with directors and then moving on to employees. The question of whether you should own and run your cars on the company or whether it should be done privately. So just moving on to the question of directors. So that we do have a rule of thumb on this, which is that generally speaking, in most situations, cars should be owned and run privately for directors. Now, obviously, as with every rule, there are exceptions, and Joe will be touching on those in a few moments. And in particular, I think the number of exceptions has probably been increasing a little bit, if anything, over the last 12 months. But we'll come on to that a bit more in a moment. The general rule of thumb is still that cars for directors should be owned and run privately. So what does owning and running privately actually mean? Well, it's two separate things. Firstly, you've got to own it privately. Now, obviously, if you own the car outright, that's kind of straightforward enough. If you have it on a lease, the important thing is that not only do you pay the expenses, pay the lease payments from your own private funds, but also the lease is in your own personal name as opposed to being in the company's name. And that's an important point because regardless of who actually pays the bills every month, HMRC will regard that as being a company car if the lease document is in the company's name. So that's just a key point to understand. In terms of running privately, what that very simply means is that all of the costs of running, maintenance, leasing are paid by you personally rather than by the company. In practice, what we tend to find works well is where the company pays the expenses as usual, and your accounts team post the expenses. Instead of posting them to Motor, they post them to your director's drawings or your loan account, and that is quite a straightforward way of managing it in practice. So if you're asking yourself the question right now, well, my cars are currently all on the company, what can I do about that? How can I get them off the company? It's a good question. Firstly, it depends on whether the cars are owned outright or leased or on some kind of contract hire arrangement. If they are leased, in practice, probably the simplest thing for you to do is to wait for the cars to the lease term to expire, and then change it when you get a new car or the car comes off the end of the lease. Because leasing companies are often not terribly keen on changing the name on the lease document mid-term. If you own outright, the best way of doing it is for you to buy the car off the company at its current second-hand market value. And that's quite an easy thing to check on Auto Trader or something like that. And if you do it at current market value, then it means there's no tax charge. It can be done as a paper transaction, so no cash needs to change hands if you just record it as a debit on your director's loan account. Ask your accountant or bookkeeper for more help with that. Just one final point on that. Just be careful with insurance if you're moving cars to private use. Often insurers will be happy to insure directors' cars on the fleet, despite them being privately owned. But if you've got shareholders who are not directors who run cars privately, the chances are they will probably have to insure the cars themselves privately. So just make sure that you're careful to make sure cars remain insured if you're doing that. So moving on to the question of fuel, essentially there's two different ways of dealing with fuel, and this applies equally to both employees and directors. One is for the company to pay for the fuel, and you get taxed on the fuel benefit, as Carl was explaining a few moments ago. Or the other is for you to pay all the fuel costs, but you claim an agreed mileage rate back from the company for any business miles that you do. So which is the best route? Well, what we've found over many years with fuel benefit is that in the vast majority of cases, it simply isn't worth the cost, the tax cost of doing it that way. And the next slide just gives us a little bit of an illustration of what those numbers might look like. Obviously, this is an example, and every case is slightly different. But this is kind of making some assumptions. If we say somebody does 10,000 private miles a year, what's the cost of providing that, of the company providing that as a benefit? Well, the cost of the fuel might be in the region of about £1,350. Plus the company is also going to pay national insurance on the provision of that benefit. So the total cost of the company is somewhere around 2,300. And of course, there's a cost to the individual as well, because you are being taxed on that benefit of providing fuel, which for a higher rate taxpayer in this example is 2,940. And even for a basic rate taxpayer, it's 1,470, which is actually more than the cost of the fuel itself in the first place. So you can see that in all but the most extreme situations, it simply isn't worth it. So what we recommend instead is that the best way of doing it is to, as I say, record your business miles that you travel and reclaim back from the company at an agreed mileage rate. What is that agreed mileage rate? Well, it varies a little bit depending on whether your car is run on the company or whether you own and run the car privately, as we were talking about a moment ago. So if the company is providing you with your car, but you're paying for your own fuel, then what you need to do is check HMRC's advisory fuel rates, which are available online, and they're updated quarterly. So they do change on a fairly regular basis. They vary a little bit depending on the type of car, the type of fuel, size of engine. But that is the rate that you should use. So keep a note of how many business miles you travel, multiply it by the mileage rate, and then submit a request to the company to reimburse that mileage rate. This doesn't have to be done in any particular formal way. There's no claim that you have to complete or nothing you have to submit to HMRC. It's literally just a case of dropping an email to your bookkeeper or accounts team. And it can either be paid in cash, or if you're a director, it can be credited to your director's loan account. Either way works. If it's a private car, exactly the same principle applies, but the rates are slightly different. So for the first 10,000 business miles you travel in a given tax year, the rate is 45 pence a mile, and then thereafter it increases to 25 pence a mile. So I think the key point here, really, sometimes it can feel like a bit of hassle, you know, isn't fuel benefit a lot easier? Do I really have to record all these business miles? But I think it's important to understand that if you're not doing that, it's a bit of a missed opportunity. So just taking the 10,000 business miles at 45 pence, for example, if you did 10,000 business miles, which is not a huge number, you could be missing out on £4,500 of reimbursement from the company, which is actually tax-free income for you. And furthermore, it's tax deductible for the company. So it's worth just being aware of that. It's a missed opportunity if you don't do it. So moving on now to employees. One trend that we've seen in recent times is clients talking about the option of providing employees with car allowances instead of a car. A lot simpler, a lot less administration for the company. And the questions come up like, what rate should we use? How much should we pay them? And is there a right or wrong way of doing it? Firstly, just to explain what a car allowance is, it's very simple. All it is a little bit of extra salary that's paid to the employee on a monthly basis. It's subject to tax and national insurance, just like the rest of their salary. And the idea is that they obviously use that extra salary to pay for, let's say, a contract hire deal or a lease deal on the purchase of their own vehicle. And there's not exactly any right or wrong with this. Either route works, car allowance or provision of a company car, but there are considerations to think about. And in particular, there are certain cars that will be much more tax efficient provided as a company car rather than paying someone a car allowance. So you're probably going to need may well need some help with this, and something that your accountant should be able to help you with, or we can help you with. But I think ultimately which route you choose depends on what your priorities are as an employer. Is it simplicity and consistency and kind of ease of administration? Well, if that's the case, then your car allowance route is going to be pretty close to the top of the list because it's quite an easy thing to do. Alternatively, if your priority is more about getting more money into the pockets of the employees, then I would suggest that a better route to go would be to look at tax efficient company car options. So just moving on, traps for the unwary, or some things that you might want to think about if you are seriously considering going down the car allowance route. Firstly, calculating the right car allowance figure is not the most straightforward thing in the world to do. And it would be easy for it to end up being unfair either on the employee or the employer. So it's important that that's set at the right level. Again, more on this in a moment. We'll be talking about ways we can help you to do that for you and your employees. Secondly, are you insured? This is an important question where you've got employees who are owning and running their own vehicles and using them for business miles. So if it's a sales rep, for example, and they're going on business journeys, it's not an automatic thing that they are insured for that. They've had to take out private insurance. It's not an automatic thing. You have to tick the option for business use. So you could quite easily unknowingly be in a situation where an employee goes on a business journey, something happens, there's some incident, and you find that the employee is not actually insured for that particular journey, and that potentially implicates both the employee and the employer. So that's not a situation you want to find yourself in. And of course, if the employee selects business insurance on their list of options, then the chances are the cost is going to go up as well. Final point on here is the question of how much is taxed. And this is particularly relevant because there's some new rules just come in, which are a bit nasty, which essentially say that if you offer an employee a clear alternative between either this much car allowance or that car, they will simply be taxed on whichever is the higher. So whichever incurs the more tax, that's how much they'll pay. So there are some exceptions to that, in particular ultra low emission hybrid, ultra low emission vehicles, cars. So that's just a key point to be aware of. And Joe will be coming onto that a little bit more in a moment. So just moving on. You might be sitting listening to all of this, and there's a lot of complexity around this, and we're the first to kind of admit that. Your fuel benefit versus private fuel, paying for it privately, cars on or off the company. And sometimes there's a question in people's minds, well, surely there's a simpler way of doing this. Pool cars is a subject that comes up from time to time. And the attraction, of course, of pool cars, probably many are familiar with it as a concept. The attraction of pool cars is that if a car meets the conditions, it's actually tax-free for the employees. So if you can make sure you tick the boxes and it's genuinely a pool car, brilliant, no tax on the employee. However, it can be a little bit more challenging than you might think. So I thought we'd just run a quick poll. But before Carl just brings up the options, I'll just talk through the different scenarios. What I want you to think about is in each of these cases, is this a pool car or is it not a pool car? So the first scenario is that this particular car always stays at the business premises. It's used for rep visits by a member of the sales team, but other than that, it doesn't get much use at all, if anything. The second scenario is that a car is used by, in this example, 3 employees on a regular basis for business use only. And because they don't want the car parked at the business premises overnight, one of them takes it home each night for security. And the third scenario is, again, the car is used in this case by 3 employees on a regular basis for business use only, except that one of them does take it home sometimes and do the family shopping on the way home. So the question is, which of those is a pool car? Is it 1, 2, or 3, or all of them, or none of them? So I'll just give you a few moments to see what you think on those. Just to get everyone thinking about this question. Okay, so I don't know whether you can see the results or not, but it looks to me like most people have selected the first option. Over half have said that the first option is a pool car. And then there's some that have selected some of the other options. So it's a bit of a trick question, I'm afraid. The real answer is that actually none of them qualify as a pool car. And it just goes to show how difficult it is to get this right. So I'm just going to show you now what the actual conditions are to qualify as a pool car. So I'll just run through these conditions very quickly. I'm really just I guess making a point here that we have to be careful to make sure we meet these conditions. If we fail any of these conditions, the risk is that it's then taxable on the employee, and both the employer and the employee end up with a unexpected tax bill on their hands. So firstly, it has to be used by more than one employee. So that's why the first one doesn't work. It has to be not normally only used by one of those employees. So in other words, it's not mostly used by an employee and some others use it for a couple of days a year. Any private use is incidental. And of course, incidental is the kind of key word there. What does incidental mean? Well, essentially what it means is that any private element of a journey essentially is for business purposes, and any private element might be something like making a diversion to buy some lunch on the way to seeing a customer, something like that. So no journey is solely for private use. And then the final condition is that it's not normally kept overnight at or near an employee's home. So bit of detail there, but just to illustrate how hard it is actually in practice to meet those conditions, and therefore the chances are that if you fail any of those conditions, which is an easy thing to do, then the car then becomes taxable in the hands of the employee that uses the vehicle. The next point is in relation to 100% business use. So this comes up in relation to sales reps, for example. Sometimes clients will say to us, well, my sales rep doesn't really come into the office. They work, their base is home, and they are traveling to a customer or home from a customer, from the moment that they leave home. If it's 100% business use, then surely there's no benefit in kind, which is absolutely right. However, there are some conditions to meet, as always, and HMRC are quite stringent about the way they apply these conditions. So the conditions are, firstly, that any private use is actually expressly prohibited by the employer, and we usually recommend that's done in writing. And secondly, there is in fact no private use of the car. So in other words, the employee doesn't break the rules. Sounds simple, but it's actually harder to meet these conditions than you might think. And you can see that if you're going to meet these conditions, even theoretically, even if there was one private journey done in a year, that would make the car taxable for the whole year. And that can be anything, including home to work, if work happens to end up being your main place of work, even for a short period of time. So, and the other thing as well is, of course, if HMRC do query it, you've got to be able to provide some evidence that there was no actual private use of the car, which, as you might imagine, is not necessarily a particularly easy thing to do. So this does work in some situations. We're not saying it's never going to apply, but it's very easy to fall foul of the rules. And once again, you could end up with an expensive tax bill on your hands if you couldn't meet the conditions. So with that, I'll just summarize, and then I'll hand you over to Joe, who's going to talk about some interesting developments. Firstly, make sure you review the ownership of your directors' cars. Are they best privately or on the company? And we talked about ways of taking them off the company if you want to run them privately. Secondly, as we demonstrated, fuel benefit is usually not a great idea. But what you do want to do is make sure that you're claiming those business miles at the appropriate rates. Big missed opportunity if you don't. And finally, think through the implications of car allowance versus company car. The question is not necessarily a straightforward one to answer, and there are implications we've talked about, like insurance, making sure that you get the right rate and so on. So with that, I'll hand you over to Joe. Thank you.
Thank you, Jerry, and some useful warnings and tips in there. I trust everyone's not suffering from information overload so far. We can promise you as you go through this webinar, the content does get a bit lighter as we go, and by the end we'll be showing you some real cars and interesting things like that on screen. So just stay with us. In this section, I'd like to throw in some alternative ideas for you, and maybe for your employees to have a company vehicle without large tax charges. So Carla's helpfully explained how company car tax works for you as a director or as an employee. However, it's worth remembering that also there's another cost to this, and it's a hidden cost. As employers, we're very much at the sharp end of this. There's also Class 1A national insurance to pay for the company to pay on the benefit in kind charge. So this can be quite significant. Obviously, the rate is 13.8%, and that's 13.8% of the benefit in kind value, and it's an additional cost of a company car that's quite easy to forget. Also, Jerry has obviously gone over the best way to run cars, and we've said usually for directors, running conventional petrol or diesel cars is best done off the company. So in other words, in private ownership. And certainly having fuel paid by the company just does not stack up in the vast majority of cases. One interesting thing to consider is that petrol and diesel cars are actually going to be banned from sale by 2035. So 2035, they're going to be banned from sale. So basically they are kind of on the way out anyway. So keep that in your mind as we go through this next section. So we're now going to look at some alternative tax efficient options. Having said that conventional vehicles are not a good idea, we're now going to look at some tax efficient options that are a good idea. Firstly, electric cars. The first point to note there with fully electric vehicles is you can claim 100% tax deduction in the first year that you buy that. It's called a first year allowance. You can claim a full write-off tax deduction against your profits. And that applies to fully electric cars purchased new, either outright or on hire purchase. And the second point that's more from the employee or director's perspective is there's 0% benefit in kind tax on fully electric cars in the current tax year. That's virtually nothing to pay, at all for the company, apart from the cost of actually providing the car. That climbs to 1% next tax year and 2% in the following, but still very minimal tax, basically. So just as an example there, on a £50,000 car, that means the employee or director would only pay £17 per month in next tax year on that vehicle. So as you can see, that is a very tax efficient option. The other point there is that there's free electric charging at work, so employees can get free fuel effectively if they charge the vehicle at work, or if they use the vehicle for business purposes, they can claim 4p a mile if they've charged it at home. So as you can see, that's quite favourable on electric vehicles, and we would seriously recommend you having a look at that. There are also some grants available on this, and just run through those. There's basically three grants available. £3,000 grant off the initial price for an electric vehicle. There's also a charging points grant. So through the workplace charging scheme, there's a grant of up to £350 per socket. So you can have up to 40 charging points per company, which should be sufficient for most businesses. And you can also claim up to £350 off the cost of installing a charger at home through the electric vehicle home charge scheme. So quite a few grants available there. So I think what we'd say on electric cars, if electric vehicles suit your lifestyle or your employee's lifestyle, electric vehicles really are a viable option for tax purposes. Jack's going to go over some interesting examples shortly, but and illustrate those, as a real examples. There are a couple of words of warning on electric vehicles. One is around insurance. insurance on electric vehicles can be expensive and in some cases might be difficult to obtain. And we've had a client who had a Tesla on order, actually on order with the manufacturer. And then they went to their insurance company and found that the young driver who was lined up for this Tesla, he was just under 25, I think. And the insurance company turned them down. They said, there's no way we're going to insure that on this policy. So just beware of that. It may be impossible or very costly to insure a high performance electric vehicle. The good news is that all mainstream manufacturers claim to have launched or be launching an electric vehicle by the end of this year. So that's quite an interesting fact. So manufacturers such as Ford and VW, they're all either just launched or will be launching an electric vehicle in this year. The next alternative vehicle that we want to talk about is commercials, and Carl's touched on it already, how favourable the van tax is. It takes you out of the regime of company car tax, you're now into commercial vehicle taxation, which is obviously quite a lot lower. And double cab pickups, if we start with those, they can be a really viable option. Again, if it suits your lifestyle and needs. The tax charge on those is between £60 and £130 a month, depending on your tax rate. But that can be actually quite good value because that includes both the vehicle and unlimited private fuel. Again, just a word of warning on that, make sure that the pickup has a payload of 1 tonne or more to make sure that it qualifies as a commercial vehicle. So double cab pickups seem to be approved by HMRC, and that's a good tax break. The same applies to vans with a single row of seats, but panel vans with 2 rows of seats, otherwise known as combi vans, have recently been ruled to be treated as company cars. So just beware of that. Combi vans are no longer treated as a commercial vehicle. And there was an interesting case, Coca-Cola versus HMRC, and HMRC won. And it went to several rounds, and they finally ruled that all combi vans are company cars. So that's no longer an option. And just a point on that, it doesn't matter, it makes no difference at all what you use the vehicle for. It's the actual specification of the vehicle. It doesn't make any difference if you bought a combi van and took the seats out, for example. That doesn't make any difference either. And finally, ignore vehicle salespeople, which may seem quite a striking thing to say, but in practice we found that vehicle salespeople will tell you that combi vans are commercials for tax purposes. It's not true. However, there are some really good double cab pickups available. So, like we've said, if that suits you or your employees, it really is worth a look on those. The next type of vehicle is a plug-in hybrid. And right now, there's a lot of new plug-in hybrids coming onto the market. They're coming onto sale. Some already are available. Some are coming on in the next few weeks. And they can be really good for tax purposes. Now, when we're talking about plug-in hybrids, it's really the ones that have an electric vehicle range. That means a zero emission range. So a hybrid vehicle that can actually run on the battery alone is what we're talking about. There's a window of opportunity there. Like we talked about the electric cars, the 100% first year allowance, that's available for plug-in hybrids of 50 grams of CO2 or less up until March next year, so March 2021. So small window of opportunity there for the plug-in hybrids to claim on your business. From that day, only the fully electric cars will qualify for that 100% write-off. On benefit in kind tax, this is quite complex, and you might want to refer to the slides when you get hold of those just to get that right. But if your company car has a CO2 emissions of between 1 and 50 grams per kilometre, the value of that car is based on the zero emission mileage figure or the electric range. So your benefit in kind calculation is based then on how many miles it can do solely on electric power before the batteries need recharging. And that's a figure that's obviously published by the manufacturer. So for example, if the car does more than 30 miles on battery alone, regardless of whether you actually do that or not, if the car is capable of doing that, the benefit in kind rate is 10% of the list price in the current year. So just an example on that, we put on screen on a £30,000 car. That means your company car tax could be let as low as £50 a month for a basic rate taxpayer. And on average, that's slightly less than a third of a conventional petrol or diesel vehicle. So you can see why we're highlighting it. It's really just come in as a kind of new thing, low taxation on plug-in hybrids. And again, most mainstream manufacturers have actually launched these vehicles or are launching them. So please, when you are looking at changing company vehicles, consider these vehicles. It's an interesting point that we'll go over later, but we're going to be offering something called a company car audit. And in that, we'll be illustrating the cost of ownership of these vehicles. Because a lot of people say, well, yeah, I'll consider an electric vehicle or I'll consider a plug-in hybrid, but isn't that going to cost me a lot more money? And it's a valid question. But when you take into the account the fact that there might be much less Class 1A to pay, national insurance to pay on the vehicle, and substantially less tax for the employee, often the overall cost can be less. So, as I say, Carl will touch on this in more detail shortly, but in our company cars audit that we're going to be offering, we'll illustrate the total cost of ownership of your current vehicle, maybe a diesel, a petrol, a plug-in hybrid, and a totally electric car, all side by side, so you can actually see what could be achieved by changing to an alternative vehicle. So the key takeaways are cars audit, and secondly, we've got on the next slide the car replacement process roadmap. So what we're suggesting is, and it's quite simple, but we're suggesting you, when you replace company cars, do it in the following order. Firstly, will any full electric vehicles work for you? If the answer to that is yes, obviously go for electric. If no, look at commercial vehicle options. There are some really viable ones. Again, if a commercial vehicle doesn't fit, look at the plug-in hybrid options as a third port of call. And then I think it's probably unlikely, but if a plug-in hybrid option isn't available in the kind of vehicle that you're looking at, obviously make sure that the petrol or diesel option is the most tax efficient that you can possibly get, or pay a car allowance. And in the company cars audit that we're going to do, we'll also show you what car allowance is right to pay, because there's a lot of confusion in that area. We've seen businesses pay huge car allowances instead of providing a company car and then regret it later. So with that, I'll now hand over to Jack, who's, as we promised, going to give us some more interesting slides, and he's going to show us some pictures and go into the specifications of some actual real cars in detail. So over to you, Jack. Thank you.
Thanks, Joe. That's good. So we've covered off the commercial vehicles, the hybrids, and the electrics. So I just wanted to cover off a few points because there may be some that are still thinking, I don't see that any of those will fit my requirements. So there are a few points to watch out if you do want to still go for a petrol or diesel option. So the first point to make is that just watch out for the additional packs, additional extras on the vehicle. It's quite easy to sort of add on a sports pack or a comfort pack or add on this little extra and that extra. But you have to bear in mind that each extra or pack that you add on will increase the list price of the vehicle. And by doing that, you'll then increase the tax you're going to pay and that the company will pay. So it's worth just, you might say, testing before you add on these packs. Are you prepared to pay more money? Are you prepared to pay more tax for that extra? And then the second point there is just checking the engine specification. I know there are some vehicles where you can get the identical vehicle, but they come with a standard front-wheel drive option or a four-wheel drive option. In many cases, the employee or a director, whoever the vehicle's for, won't necessarily need a four-wheel drive option, and they won't necessarily particularly want it. But by and large, the four-wheel drive option will have higher CO2 emissions just by nature of the engine. And so that will obviously then increase that percentage that Carl spoke about earlier, and therefore increase the tax that is paid for something that, frankly, the driver might not even know they had. And the other point in relation to diesels is what's called RDE2 compliance. Now, it sounds fairly ominous, but this is a new standard of emissions testing for diesel engines, further to the VW emissions scandal, we might say. So Carl spoke about earlier the percentage that is times by the list price of each vehicle. Now, just to sort of explain that a bit further, HMRC publish a register or list, and you can check your CO2 emissions, and it might say 30%, which would usually apply to the petrol option. Where you have a diesel, there is a 4% diesel surcharge. So, for example, if your CO2 emissions were 135 grams, if it was petrol, you'd be taxed at 30% of that list price, but a diesel would be 34%. If a diesel has been registered as RDE2 compliant, that does remove the need to add that 4% diesel surcharge. So instead of the 34%, you'd be your rate would be 30%. So it's only a new standard that's relatively new come out, and we've included on there a link which is useful and is updated fairly regularly with vehicles that have been registered as compliant. And I would just keep an eye on that. It does update every so often with more vehicles. So we've spoken quite some detail about the tax aspects, and perhaps you might be sat there wondering what on earth the reaction is going to be when you go back and suggest you replace your fleet with a fleet of perhaps Nissan Leafs or something like that. It might not go down too well. So we just want to give you some practical options and examples and just really broaden your outlook. I know for many it's sort of an electric just doesn't seem an option, but I think over the last 6 to 9 months there's been a massive increase in the range and availability and quality of the vehicles available. Just to note there, we're not recommending these vehicles, and this is not covering all the options. We've just selected a few, but it is your responsibility then just to check the costs, the specifications, the insurance and the tax on any vehicles before you purchase. And this list is by no means exhaustive. So we've really split it down into different categories of employee, you might say. Obviously different employees at different stages of life have different requirements of the vehicle. So our first category of employee is what I've just called an office-based administration role. So someone who's mainly office-based, don't do any business miles, their personal mileage is also quite low, and they're probably a 20% taxpayer, because they don't need a big car, a big fancy car, but they just need something to get them in to work each day. So for this one, the first comparison we've made there is on the left you can see a Renault Zoe GT line, and on the right is a Seat Ibiza FR. Just to give you some detail, the Renault is a fully electric vehicle, and it has a driving range of about 238 miles. So for those that are just coming to and from work, perhaps a little bit of personal mileage as well, 238 miles of range is going to be ample, even if they decide to do a bit of a long trip one day. In terms of cost, obviously, the electric version qualifies for 0% benefit in kind this year, and the employee can charge the vehicle at work. So you can see that the cost for the employee is £0 per month. Compared to Seat though, the cost of tax plus fuel is likely to be about £183 per month. So instantly that employee, just by changing their vehicle, has got another £183 in their pocket each month. And as Joe mentioned earlier, a question that often arises then from an employer's perspective, but how much more is the Renault going to cost me? How much extra is it going to cost? Now, you need to check the individual contracts available, or what deals are available for you. But as a sort of a guide, we did a comparison between these two vehicles based on some actual contract hire contracts available, like for like contracts, and the Renault actually only cost the business about £5 per month more. So £5 per month more, but the employee gets £183 per month more. And just to reassure those who might think the Renault only does top speed of 30 miles an hour, it does have brake horsepower of 135, which is actually more in brake horsepower than the Seat does. So it could definitely be an option. Our next option for this category of employee is the Seat Leon e-hybrid, which you can see on the left there. Now this is expected to be available for ordering over the next month or so, and it's a plug-in hybrid, so it has a petrol engine and an electric engine, and because it's plug-in hybrid and the range that it does, it's only the benefit in kind tax rate is 10%. So that is a very efficient option. For those that want to perhaps take it to the next level, perhaps enjoy quite a bit of speed, the right hand side there you can see is the Cupra version. So that is again a hybrid, but it does have the Cupra style and is also 240 brake horsepower. So that should satisfy even the most sort of thrilling employees that you have. So our next category we want to look at is an office-based salesperson. So again, mainly an office-based person, but perhaps someone that has requirement for a bit of either a bigger or a better vehicle. So not too keen on traveling around in a little Renault Zoe or Seat Leon. They want something sort of next level up. So a fairly typical option would be the Tesla Model 3 there, you can see. Obviously, as we've said, it would be 0% benefit in kind at the moment. There'd be no tax for the employee to pay. They could charge it at work. The long range specification on that has a range of 360 miles. This obviously is only an estimated range, but so that should cover any additional long journeys they want to do. But the only point just to make sure is, just as Joe mentioned before, check on the insurance. It could be very difficult or costly to insure a younger driver on these vehicles. So another option for that category is perhaps based more on a family scenario. So perhaps need a bit more space than the Tesla Model 3, or they perhaps don't like the look of them, don't like the style of them. This is the Skoda Enyaq, which is the new Skoda model, and is expected to be available for ordering in early 2021. As you can see, it offers a lot more space than Tesla, so it could be very useful for family, carrying family around. It's a wholly electric SUV, and the range is expected to be about 316 miles on this. And the other point to note is the cost is not too significant. It might look reasonably expensive, but they expect it to cost from £33,000, so not out of the world. And again, 0% benefit in kind. And then final option on this employee would be the Ford Cougar plug-in hybrid, which you can see there. So this is a petrol and electric engined plug-in hybrid. It does qualify for 10% benefit in kind because of the range that it does. This is currently not available for ordering, but they are expecting it to be available again in early 2021. So that's another option to look at. Next employee you want to look at is perhaps a more difficult one. It's the one that is doing typically high mileage. They're probably a high rate taxpayer, but they need a vehicle that's not going to have to stop every 100 miles and charge for 4 hours. Because they've got appointments to get to, they're travelling up and down the country. So this is typically the one where many employers will say just there isn't any tax efficient options available. And traditionally that has been the case. However, over the last probably 9-12 months, there have been some options come available. So the first one we want to look at is the Skoda Superb. You can see there, they have released a hybrid engine in this one. So it's the standard Skoda Superb. It's got all the benefits. It's got a lot of space in it, but it doesn't have that problem where you're having to stop every 200 miles to charge because it's got a petrol engine in there as well. So basing it on a 40% taxpayer, we did a comparison between the exact same models, just with a hybrid and a diesel engine. The cost for the company was actually pretty much identical. There was no real difference. But you can see there the cost to the employee. The hybrid was going to cost about £138 per month. But the diesel, however, was £424 per month. So with no extra cost to the employer, you've got nearly £300 additional per month for the employee. So that is definitely a very viable option to consider. And our next one is really, I just want to prove that a tax-efficient car doesn't have to be a boring car. So this is the Skoda Octavia VRS, which they have just released the hybrid version. I think it became available for ordering last week. So this is a very tax-efficient car because it's obviously only taxed with 10%. But the key with this is that you've got a 245 brake horsepower car at very low tax rates. And the benefit, Carl mentioned earlier, the list price and the percentage. So with this one, you've got a low percentage because it's a hybrid, but you've also got a relatively low list price because it's a Skoda, so it doesn't have that high list price. Just looking at one option on this, I think working through a 40% taxpayer, this could cost about £117 per month in tax. Now, just to put that in context, really, if you were to offer that employee a Corsa van, so just a standard commercial Corsa van, I think they pay £116 per month in company car tax. So the employee is effectively paying an additional £1 per month to upgrade from a Corsa van to an Octavia VRS. Know which I prefer. So moving on then to a different category of employee, some options on this, is the what's called the manager category. So a high rate taxpayer, mainly office based still, but they're perhaps looking for the next level up of vehicle, perhaps a bit more luxury, a bit more prestigiousness. They just want that next level up, which can be more problematic in terms of high list price vehicles. So first off, we looked at the Volvo S60, which typically is available in a petrol engine. However, they do also do what they call a recharge engine, which is the hybrid version. Now, this one, when you compare it, does, on the calculations we were looking at, it was costing it was costing more for the employer. Once you take into account the reduction in Class 1A national insurance, though, it was costing about £100 per month extra to the employer to get the recharge version over against the petrol. But the thing is, it was actually saving the employee approximately £280 per month. So to give you some idea, that is it. Effectively, it's the same as giving that employee an equivalent gross pay increase of £5,800, but actually it's only costing you £1,200 per annum. So that's another way to look at it. You might think, yes, it's going to cost me more, but perhaps when you next come to increase their salary, perhaps view this as a way of increasing their salary. You're getting more into their hands, but it's not actually costing you as much. Another option we looked at on the manager option was the DS7 Crossback, which is a 4x4 vehicle, more of a luxury vehicle, you might say. It costs about £47,000, so it's not a cheap vehicle, but it's not a ridiculous cost. But as it's a hybrid and the range it does qualify for the 10%. So again, just give you some numbers on this. A 40% taxpayer like this manager would be, they're only going to pay £159 per month in tax for this vehicle, which if you compared it to exactly the same vehicle, just a diesel motor inside it, they'd be paying about £590 per month in tax. So again, you've got over £400 saving just by changing the engine that's in the same vehicle. And then a final category of people that we want to look at is the directors, which I know Jerry covered earlier. It's often best to have them privately, but just to put it out there that it's not necessarily, in a sense of, yes, if it's a petrol and diesel engine, chances are it is, but there are options available for directors. Two, which I haven't mentioned, which we commonly come across, is the Tesla's Model S and Model X, very popular directors' vehicles, and of course they qualify for 0% benefit in kind. One option I wanted to look at was the Polestar 2, which is not very common. People might not have seen it. It is based on the Volvo, but it is a separate company. But this is a high-speed, fully electric option. It starts at around £47,000 again, but it's wholly electric, so it'd be 0% benefit kind this tax year. And just to give you a few statistics, give you a feel for the car, make sure you're not thinking that all these cars just fairly plain and boring. This one has a range of nearly 300 miles, 292 miles at the range, but it does have just over 400 brake horsepower, so it can do 0 to 60 in about 4.7 seconds. So it's definitely an option for those that are heavy on the right foot. And final option I want to look at for a director would be the Volvo XC60 Recharge. So that is the plug-in hybrid version of the Volvo XC60. The point I make on this one is it very much depends on your circumstances, depends on a number of factors, including what mileage you do, what split of business and private mileage, as to whether this would be best to have on the company or as private. So don't just presume that it is best on the company. It's best to check it first. So with that, I'd just like to finish off, just encourage everyone on this call this afternoon just to be broad-minded when they're looking at replacing vehicles. There are so many options that are tax efficient nowadays, and if you look ahead in the next 6 to 12 months, there are so many more coming available. As Joe mentioned earlier, all the main manufacturers are bringing out electric and hybrid options, and I wouldn't necessarily just rule them out. So with that, hand over back to Carl. Thank you.
Thank you, Jack. That was very interesting. All those different options you gave to us there. So we're now going to move on to the question and answer session, and we've had some good questions flooding in as we've been been talking and we've been having a look at those. So I'm going to open the floor to some questions now. So I think, Jerry, you touched on this, so I'm going to see if you can help on this first question. If you put vehicle expenses through as director's drawings, can you claim VAT back? I think you touched on that, Jerry. Can you help us with that one?
Yeah, that is correct, and it's a good question, particularly for repairs and maintenance costs, so servicing tyres, that kind of thing. You can pay the expenses privately, and the company can claim the VAT back, provided that two conditions are met. Firstly, the company actually pays the expense, so it's not coming out of a private bank account, the company is actually physically paying it. And secondly, the car does do some business miles from time to time. But as long as it meets those conditions, you can claim the VAT back on those expenses. What you can't do, however, is claim the VAT back on private lease costs, even if it's paid by the company. So there's a bit of a distinction there between leasing costs and repairs and maintenance costs. Does that make sense, Joe? Carl?
Thanks for that. Good. Another question we've got here. Can a company pay for fuel and then invoice an employee for private fuel? Jack, what's your take on that one? So can a company pay for fuel and then invoice the employee for the private fuel?
Yeah, I think the key point is that the employee is paid. I mean, you could, I think, but it's difficult. I think the key point is that it would be simpler if the employee just paid for their fuel and claimed back business miles. It's just very difficult if the company is paying for all the fuel to make sure you are literally checking all the amounts and keeping an accurate record of it. I don't know if you've got any other comments on that.
No, I think that's good. I think that's right. Basically, in principle, that's fine to do. You know, the company can pay for the fuel, and the employee needs to be paying back any private fuel, at least at the advisory fuel rates. But as you say, Jack, it can be simpler sometimes just to do it the other way around. But so hopefully that answers that question. Got a question here. If more than one family member share a vehicle for commuting, i.e. siblings, brothers and sisters, that's owned by the business, do they get taxed as if it was a vehicle each, or is the tax split between them? So that's an interesting question. I think, yeah, we've had that come up before, and it is possible to split benefit in kind between employees. The only thing I would say again is that the practicalities of getting HMRC to realise that has happened is a bit of another subject. But in theory, yes, the benefit in kind can be split between different employees. So some more questions here. Got more questions flowing in. Question here, Jerry, which I'm hoping you can help with. Is there any benefit in using salary sacrifice schemes?
It's a good question. These days, not a lot, unless you're talking about ultra low emissions cars, so below your 50 grams per kilometre. The salary sacrifice schemes do work for that. So what that simply means for those that are not familiar with salary sacrifice is that the employee agrees to take a salary reduction in exchange for a car of roughly the same value as the salary sacrificed. And what that then means is that hopefully they are making a tax saving, and the employer is making a tax saving on national insurance mainly as a result of getting a car instead of that extra salary. Now that works for ultra low emissions cars, but not for not for normal cars, other than schemes that are already in place, have been in place for some years, but even that's coming to an end from March next year. So certainly from April next year, salary sacrifice schemes are out of the window unless you're talking about ultra low emissions cars, which also really goes back to the point that we tried to make earlier, which is that you've got to be careful with this kind of, you can either have a car allowance or you can have a car, kind of very, very clear alternatives. HMRC will tax you on whichever is the higher, so there's no advantage in doing so unless it's an ultra low emissions car below 50 grams, so your hybrids or electrics. I don't know if that's very clear or not.
So what you're saying is, in theory, it does work for salary sacrifice schemes, can work for low emission cars, but actually the low emission cars are the ones that are low tax anyway, so it's the kind of actual value of it is very limited when it comes to company cars, basically. Yeah,
so it's a good thing to do for if you're talking about ultra low emissions cars, but for standard cars, I definitely wouldn't do it now.
Okay, some more questions here. Joe, this is one for you. Do these rules apply to partnerships, or are they treated differently? So I guess the sort of main sort of point of that question is what we've said in this presentation. Does it only apply to companies, or does it also apply to partnerships?
Well, the whole field of company car tax obviously does apply to partnerships in terms of any employees of the partnership. So everything we've been saying is applicable to employees, but partners of a partnership or members of an LLP are treated differently to directors. I think that's the clearest way of putting it. So when we talk about directors, we mean directors of a limited company. And if you are a partner in a partnership that's trading and you have your vehicle that way, yes, it will have different rules in that case. Is that clear, Carl?
Yeah, that's good. I think what's good to remember is those points that you mentioned about getting 100% deduction for electric vehicles in the first year, and also getting a 100% deduction for commercial vehicles as well in the first year if they're done right. That all still applies to partnerships.
Is it also worth just mentioning on that point that sometimes we do get clients saying, can I just set up a partnership and run my cars through that? And broadly speaking, the answer is if you're just setting up a partnership to run the cars, that doesn't work. And there have been a few cases that have gone through the courts where it's been ruled that that was still a company car and still subject to car benefit tax, despite it theoretically being owned and run in a partnership. So if there's a genuine bona fide trading partnership and you trade as a partnership and you're providing yourself with a car through that, that's fine, but not if it's just a cars partnership that isn't doing a lot else.
Just very quickly on this same vein, we've got something just popped in about does this apply to hybrid partnerships, which I'm guessing means that a partnership which has got limited company partners as well as other types of partner. The point about that is that normally the way that in that situation, the owners are remunerated is through the limited companies, and so you're taxed on company cars just like any other employees are effectively. So everything we've said applies. That makes sense. Some more questions here. We've got time for just a few more. If you pay for employees' insurance on their private cars, is that a benefit in kind? It's an interesting one, Joe. I don't know if you'd be able to help on that one. So the question is, if you pay for employees' insurance on their private cars, is it a benefit in kind?
Yes, that's obviously taxable to the employee, isn't it? I don't know, you've probably, anything else you wanted to say on that one?
No, I think that's fairly clear-cut answer. Got another question here that we've said that it's generally better for directors to own and run their own cars. And is this still valid if they don't do any or many business miles? That's a it's an interesting question. Basically, we've done sort of hundreds of calculations on this, covering quite a large sort of variation in different types of car. And really, our rule of thumb that Jerry mentioned about earlier on, the fact that normal petrol or diesel cars are better run privately if you're a director, still stands really, whatever kind of mileage you're doing. And the fact is, it's because the company car tax, the benefit in kind, doesn't change if you're doing more or less miles. It's just exactly the same. And that's the killer, if you like, when it comes to directors' cars. That the benefit in kind is the reason why it's better to run the cars privately. So hopefully that answers that question. That it doesn't really matter what the miles are. In some ways, it's still better.
Just to back that up, Carl, just did a calculation for directors the other day. They actually were only doing about 1,000 business miles per annum, so very low. But it was going to save them about £4,000 per annum to have it as a private car, not a company car.
Good. Thanks for that, Jack. We've probably got time for just about one or two more questions. Just have a look through here, see if there's some common themes that we can wrap up in one question. You've got a couple here on the same sort of theme about justifying your home being the main place of work, and we've got a question here: can we claim business miles on trips to and from head office if we're saying our home is our main place of work? And on that same vein, is it legitimate for a business to register a salesperson's home address as their office address, so mileage to and from classed as business mileage? So I think they're both the same question. What do we think on that, Jerry? I don't know what your thoughts would be on that one. I think you touched on that earlier.
Yeah, so it comes down to, it's not just a case of registering an address exactly. It comes down to, in practice, where that employee is actually based in practice. So if in practice they're spending most of their time at home when they're not out traveling, seeing customers, then I think it probably would be fair to say that home was their base. If, however, they are spending time in the office, say the majority of days in a typical working week, then that's going to be harder to argue. So it's about where their permanent workplace is. And if your permanent workplace is from home, then yes, you can claim any trips to the head office as in business miles, because it's not your main place of work.
Good. Thanks for that, Jerry.
Just one further question I'd like to answer, Carl, if that's okay. I've got a few minutes, haven't we? One of the questions coming in was, will the tax rates go up? We've talked about zero rates, 0% and so on for electric cars. Will they go up over the next 3 to 4 years? Just a point on that. The government do publish tax rates 3 years ahead, don't they? So you have got that window. They rarely change that. You just got to keep your eye on it. Every 3 years, you'll find they'll update that. So we do know that, excuse me, for 2021 and 22, the tax rates on electric vehicles and plug-in hybrids are very, very low. It's difficult to get through to Rishi at the moment to ask him what he's got in mind, but I don't know beyond that, I'm afraid.
Yeah, that's good. So we've got some visibility ahead on that. As it stands at the moment, we've got some visibility on the rates for electric cars and so on, and that's all out there. Just one quick question as well, just quickly while we're on Q&As. There's just a question: while fuel benefits not normally worthwhile for cars, would it normally be worthwhile for a van? Well, yeah, basically, rewind right to the beginning, the actual fuel benefit tax on a van is much lower than on a car. And I think you touched on that point as well, Joe. So yeah, you need to look at the circumstances, but it definitely can be worthwhile having fuel benefit on a van in certain circumstances because the tax is much lower. Good. I think we have to close off on the Q&As at this point. Hopefully we've done everything we can to answer as many of those questions as clearly as possible. So we're now going to just summarize the actions very quickly. I realize we're very close to the end now. So just to summarize on the key actions, so I think it's really important that you take some tangible actions away with you so you can really take them away and put them into action and get the value out of today's session. So I'm going to summarize these for you. So the first one we've got here, look at the situation with directors' cars, as Jerry's mentioned. If the directors have got, and they're going to continue to have just normal conventional petrol diesel cars, it's basically normally better to have those run privately. So you need to look at that situation. Quite the subject we've talked about, Jerry touched on about fuel benefit. Basically, most of the time it's a waste of time. So basically scrap it. Make sure you're claiming business miles, make sure you're not losing out on those allowances. And think through the implications of paying a car allowance versus company car. And Jerry kind of pointed up some key points earlier on, such as insurance, making sure you get the right level of car allowance, so that it's not unfair on either side, and the points on optional remuneration. So just need to think that through carefully and just remember that it might not necessarily actually be the most tax efficient option. Key takeaway here, if you're thinking about replacing cars, just think about Joe's flow chart that he talked about earlier. Consider your options in the right order. Think about electric cars first. Will that work? If not, think about commercial vehicles. Will that work? If that won't, think about the hybrid options. Will any of those work? And only if you've sort of exhausted those three options, then look at a normal conventional diesel or petrol car. And if you're doing that, make sure you actually look at the most efficient option possible there, or pay a car allowance. If petrol, diesel cars are the only options, as Jack mentioned, watch out for the extra packs that push up the list price, and check for the most tax efficient engines. Jack touched on some key points there on new diesel engines. Don't be narrow-minded, as Jack demonstrated. There are plenty of options out there for sort of non-conventional vehicles, for electrics and hybrids. Don't be narrow-minded. Don't just rule those options out. Make sure you do think them through and look at them, give them some serious thought. And final point, carry out a company cars audit, as Joe mentioned earlier. As we sort of touched on before, the general kind of problem with company cars, with the whole realm of company car tax, is that it's changing the whole time. It's kind of like there's a moving picture the whole time. As we mentioned, what you did a few years ago isn't necessarily the right thing to do now. And I think we've probably fallen into the assumption that just sort of paying a car allowance on a monthly basis is probably the best thing, when it might not necessarily be the best option. You can easily end up with a situation where you're going down a route that actually isn't the most tax efficient, isn't the most cost effective. And that can obviously have quite a knock-on impact on the employee if they're losing out on sort of net pay in their pocket that they could be having. So that's what we're talking about on a company's car audit. It's something that we can look at doing for you, where we'll assess your current employees' car situations. We'll look at their cars, look at their situations, look at what their circumstances are, what kind of mileage they need to do and so on. And we'll illustrate the options for that employee. So we'll illustrate the diesel options, the petrol options, the hybrid, the electric. And we'll calculate a 3-year cost for the employer of that car and also for the employee. So it just means straight away you can easily see what is the best option for this particular employee's circumstances. What's the lowest cost for them in terms of tax, and what's the lowest cost for you as an employer. And we can also calculate a suggested car allowance if that's the route you want to go down. I know there were some questions that came up about sort of how to calculate the best and right level of car allowance. So we can look at that for you there. And obviously there's potential here to save hundreds of pounds per employee per month. As I sort of touched on at the start, that situation where we had an employee that was kind of paying £500–600 per month in company car and fuel benefit tax. Well, looking at his situation and getting it right meant the employee could save, around £400 a month, which was a massive saving and a massive help for that particular employee with their take-home pay. So just to leave that with everyone. If it's something you're interested in, then feel free to get in touch after this event. There's an email coming around shortly with the copy of the slides, and there'll be a link on there to book in a quick call with us if you're interested in looking at a company cars audit. So we'd like to wrap up with that and thank everyone very much for joining us on this afternoon's event. And we've really enjoyed having you on board. Really enjoyed the questions that have come in that you've given us, and look forward to seeing you again soon. Thank you very much.